Yeah, the question that's been raised is, how have a range of alternative investments performed relative to the traditional stock and bond markets over the last several years? And certainly the word alternative is just that. Alternative assets hopefully give the opportunity for different return opportunity sets in different market environments that those are traditionally there in the stock and bond area. Certainly way back when, I think only 20 years ago, surprisingly, the alternative markets were called something different. They're called absolute return vehicles. And the concept there was that these particular vehicles were traded by active managers who potentially could make money in all market environments. Well, we certainly know that over the year of 2008, that alternative investments are not absolute return investments. They cannot and have not necessarily given positive returns in all market environments. In 2008, many of the particular alternative investment vehicles that either had equity embedded in them, because that's the markets they trade in, equity long short, perhaps even equity market neutral. Perhaps those particular assets that were exposed to high yield or credit spread, distressed, convertible, likewise had a difficult time performing well in markets in which interest rates rose, credit spreads rose, or stock markets fell. So in 2008, when stock markets were down perhaps 40% many times globally, when high-yield bond markets were down certainly inside the teens, so many of these so-called alternative investment strategies that were exposed to equity risk, they were exposed to interest rate risk, even some of those particular strategies that we thought weren't exposed to either, commodities, were exposed to a decline in demand in global markets. And when stock markets fell and when high yield went up and the overall economy fell, demand for commodities fell. In the latter half of 2008, commodities fell likewise. So certainly what we found out in 2008 is that alternative investments, by offering a differential return opportunities in some markets, likewise in other market conditions may not provide the kind of diversification that many investors were thought to believe existed within those underlying products. So if we quickly review those particular products again, but perhaps they have been giving you some of the diversification. I don't want to indicate to the possible readers or listeners to this that those particular investment vehicles perform poorly in all circumstances. Hedge funds lost about 20% in 2008. Many hedge fund strategies lost maybe between 20 and 25, maybe half of what the stock market did, because of their ability to take short positions to more actively manage in a way that they weren't exposed directly to a simple benchmark approach to investment management that exists in the long-only traditional world. So while hedge funds didn't perform as well as maybe people had hoped, they certainly outperformed many of the underlying stock markets that exist in the marketplace. What about commodities? Commodities did very well for the first half of the year, and the last half of the year in 2008, they unfortunately performed poorly as the overall marketplace collapsed. What about CTAs? Managed futures. You would like to think managed futures, among many alternative investment vehicles, would have offered the real kind of diversification benefits, being in fact they can easily go long and short. Here's a classic example where a particular asset class performed as expected. In 2008, CTAs performed relatively well and had an up market, quite often 20, 30% relative to the decline market inside the stock market. Why? Because CTAs could go short interest rates, short a wide range of vehicles. In those markets, we had a tendency to trend down in 2008 because of the kind of cyclicality movement of stock markets fell and continued to fall in the latter half of that particular year. 2009, stock market went back up again. What happened to CTAs? Had a hard time in 2009. One of the reasons is that almost every single market traded off the stock market. You didn't get the kind of diversification across many markets that CTAs generally trade in. 2010, CTAs have started to return and are up for this particular year as the stock market is up a little bit. So here we see between both in the hedge fund area, while they provided some kind of protection against losses in the traditional market, they didn't provide the kind of pure absolute return process that many people would have hoped. In terms of managed futures, they did relatively well. Commodities, well, they had a tendency to not perform as well in the latter half and remain susceptible to some of the global market conditions that helps traditional stock and bond areas. Real estate went down in 2008, right? Affected by the same kind of overall demand impacts that affected commodities, but also the interest rate world, which rose rates and made it difficult for people to obtain capital. So again, it's a very broad world of investment vehicles out there. And people have to understand that commodities, real estate, hedge funds, CTAs, and a broad range of private equity and other investment vehicles are an important part of their portfolio. But please, don't view them strictly as absolute return vehicles. Understand that you need to find out the benefits and the return processes that really form the basis for the return. One of the things we've produced at INGARM, the Institute for Global Asset Risk Management, are a set of research and educational pieces that we really do believe offer a better oversight, right, to investors exactly what these markets are, what these strategies are, when they make money, when potentially they may not make money, and various kinds of underlying risks that exist for them as standalone investments and how they fit within the portfolios of other investment vehicles. So we recommend all particular investors out there to go to their website, take a look at the annual updates of our benefits, our myths, and our frequently asked questions papers. We think they offer you a great opportunity to get a real insight into the use of these vehicles alongside traditional assets.